To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Now let's look at Rule 32.2, my dear friends. What is Rule 32.2 is talking about? Rule 32.2 is talking about money changing activity. Now what is that? This rule is very important and interesting. High possibility that question can come in the exam, and it has already come in the exam in the past attempts. Listen what I'm talking. Let's take a wonderful example here. Listen. So let's say there is somebody known as Thomas Cook. We know Thomas Cook, right? Thomas Cook is basically an agent who is engaged in organizing tours, whether it is domestic tours or international tours. Thomas Cook is one such entity which is engaged in organizing tours. Apart from organizing tours, Thomas Cook is also an authorized money changer. They are also engaged in money changing activity. So now listen. Let's say there is one person known as Mr. Akash and there is Thomas Cook. Mr. Akash is basically an Indian, born, brought up in India, and Akash one day decided to go to US for a vacation along with his family. Now when Akash decided to go to US for vacation along with his family, Akash wanted to procure US dollars in India. How will procure US dollars? Obviously, Akash will pay Indian rupees and take dollars. And Akash approached Thomas Cook and checked with them what is the exchange rate for US dollars so that I will pay Indian rupees and I'll take US dollars. And I'm sure everybody knows the fact very clearly that with respect to any foreign currency, there is a different rate of buying rate and selling rate. The rate at which they will sell is different. The rate at which they'll buy is different. And obviously, selling rate will be higher than buying rate. We are talking from their perspective. They sell at a higher rate and buy at a lower rate. Obviously, straight simple point. So now here, what happened is that Akash contacted Thomas Cook and told them that I want to procure $1,000. And then Thomas Cook has specified that our selling rate is 75 per dollar. So if you want $1,000, you pay 75,000 Indian rupees. We will give you $1,000. So in this particular transaction, what has happened, friends? Akash has given 75,000 Indian rupees to Thomas Cook and Thomas Cook has given $1,000 to Akash. Now question is all about, with respect to this transaction, how do we do the valuation? Listen. Now, one point is very clear. In Rule 32.2, let me tell you, we have got two sub-rules again. We have got Rule 32.2a, Rule 32.2b. Rule 32.2b has got separate mechanism of valuation with respect to based on currency exchanged. Based on the currency exchange, based on the amount of currency exchange, we have got some specialized valuation given by Rule 32.2b. That we'll talk slightly later, but first we'll talk about Rule 32.2a. Now Rule 32.2a specifies that something like this. There could be two scenarios. Scenario number one, in a transaction Indian rupees is involved. Scenario number two, in a transaction Indian rupees is not involved. Now what is that we are trying to say when we say that Indian rupees is involved? That means there could be a possibility here, what we discussed just now, that Akash is giving Indian rupees and taking US dollars. Correct? Second possibility is Akash is giving dollars and taking Indian rupees. That means in this transaction, Indian rupees is involved. Next possibility is that Akash himself has given US dollars and taken UK pounds, or he has given pounds and taken dollars. So there could be two possibilities. Possibility number one, in a transaction, Indian rupees is involved. Possibility number two, in a transactions, Indian rupees is not involved. And technically we say, if neither of the currency exchanged is Indian rupees or either of the currency exchanged is Indian rupees. Now listen, what they have specified is that we know the fact that for every kind of currency, for every foreign currency we are talking about, there is something known as RBI rate. We know that the regulatory body for all the banking institutions in India is nothing but the Apex Bank of India, which is RBI, Reserve Bank of India. And Reserve Bank of India generally gives exchange rate for every currency on a daily basis. And even in a single day also, the currency rate keeps on fluctuating basis the demand and supply of that particular currency, basis the imports and exports. What is happening? The exchange rate keeps on fluctuating. Now, there are two interesting points here. Point number one, if RBI reference rate is available, then in that case what they have specified is that value of supply will be the difference between RBI rate minus the rate at which the money exchanger exchange the currency into the amount of currency. That becomes the value of supply. Now what does that mean? Let's talk in numbers. See, for example, listen. What has happened here? Our person Akash came to Thomas Cook and he paid 75,000 rupees and took $1,000. That means what is the exchange rate? 75 rupees is the exchange rate. And assume for a second, RBI rate for that currency is, let's say, 74 rupees per dollar. The exchange rate of Thomas Cook is 75 per dollar, but RBI rate is 74 per dollar. What is the difference? The difference is nothing but 1 rupee. That 1 rupee into how many dollars are involved? $1,000 are involved. Clear, right? So 1 rupee into $1,000 will become 1,000 rupees. That becomes the value of supply for Thomas Cook. So friends, if RBI rate is available, the difference between RBI rate and the exchange rate of the money changer will become the value of supply. Now second possibility, if RBI rate is not available. Why RBI rate is not available? Sir, some popular currencies like US dollars or UK pounds, RBI rate is available. But there could be some case where some currency we are exchanging to Indian rupees and RBI rate for that currency is not available on the date of exchange. So if RBI rate is not available, then they clearly specified that value of supply will be 1% of currency exchanged. Now what is 1% of currency exchange? For example, in the transaction between Akash and Thomas Cook, the amount of currency exchange is 75,000 rupees. That 75,000 into 1%, which comes to 750 rupees, that becomes the value of supply. So first point, if RBI rate is available, the difference will become value of supply. And if RBI rate is not available, then the value of supply will be 1% of currency exchanged. Then finally, one last point in Rule 32(2)A, my dear friends, that is, if neither of the currency exchange is Indian rupees, that means we have given one foreign currency and taken another foreign currency. If neither of the currency is Indian rupees, my dear friends, in that case what we do is we convert that into Indian rupees and check whichever is lower of that 1% will become the value of supply. Now what does that mean? Let's talk in numbers. See, for example, let's say Akash has given $1,000 and he has taken 800 pounds. Clear? Akash went to Thomas Cook, he has given $1,000 and from Thomas Cook he has taken 800 pounds. Now what we'll do is we'll convert the $1,000 into Indian rupees considering the RBI rate, and we'll also convert the pounds into Indian rupees considering the RBI rate, and out of those two we will check whichever is lower, and of that 1% will become the value of supply. So friends, to summarize the whole concept, Rule 32(2)A is what I am talking. I am still not yet done with Rule 32(2)B. We are talking about Rule 32(2)A. Now Rule 32(2)A specified that if RBI rate is available, then the difference between RBI rate and the exchange rate will become the value of supply. Second, if RBI rate is not available, then value of supply will be 1% of currency exchanged. Finally, third point, if one foreign currency is converted into another foreign currency, then the value of supply will be 1% of lesser of two amounts when converted into Indian rupees. That is the story of Rule 32(2)A. Now, let's also talk about Rule 32(2)B, my dear friends. Now, what is Rule 32(2)B? Rule 32(2)B is also one method of valuation where we do the computation of value of supply based on the amount of currency exchanged. In simple terms, we say based on the gross amount of currency exchange, we do the valuation for that currency exchange activity. And let me tell you here, Rule 32(2)B is an optional rule. But if Rule 32(2)B is once opted, it cannot be withdrawn during the remaining part of financial year. That means in a particular financial year, if a money changer or somebody like Thomas Cook, if they opted to apply Rule 32(2)B, then in middle of the year, they can't come out of Rule 32.2b. I repeat one more time, Rule 32.2b is optional, but it cannot be withdrawn during remaining part of financial year. That means if Rule 32.2b is opted, it cannot be withdrawn during middle of the financial year. Now what happens in Rule 32.2b? Valuation is made based on the amount of currency exchanged. And what they have given is that something like this. Listen, Rule 32.2b valuation. I'll take two columns here. Number 1, gross amount of currency exchange. Number 2, value of supply. Listen, first, up to 1 lakh. If the currency exchange value is up to 1 lakh, then value of supply will be 1% of gross amount of currency exchanged. See, for example, let's say currency exchange is 70,000 rupees. Then value of supply will be 70,000 rupees into 1%, which will come to 700. And let's say if currency exchange is 85,000 rupees, 85,000 into 1% will come to 850 rupees. So if the amount of currency exchange is up to 1 lakh, then the value of supply will be 1% of currency exchanged. But one catch point there is, they have given minimum 250 rupees. That means value of supply will be minimum 250 rupees. Now what does that mean? Let's take an example. If the currency exchange is 30,000 rupees, then what is the value of supply? 1% of 30,000, which comes to 300. Done. Fantastic. Now let's say for a second, currency exchange is 20,000 rupees. Then 1% of 20,000 will come to 200 rupees. But even though it is coming to 200 rupees, still we will take the value of supply as 250 rupees only, because the minimum figure will be 250 rupees. Come on friends. So what is the value of supply now? Come on. So if it is up to 1 lakh, 1% of currency exchange, minimum 250 rupees. Second line, 1 lakh to 10 lakhs, then it is 1000 plus 0.5% of currency exchange in excess of 1 lakh. Why 1000 has come? Obviously, common sense point, 1% of 1 lakh will be 1000. Sir, this is something like slab rates. Like how in income tax we have got slab rates, like that we are talking here. So if it's up to 1 lakh, 1% of currency exchange, minimum 250 rupees. Second line, 1 lakh to 10 lakhs, it is 1000 plus 0.5% of currency in excess of 1 lakh. So let's take an example. Currency exchange is, let's say, 4 lakh rupees. So if 4 lakhs is currency exchange, then the value of supply will be 1000 plus 0.5% of 3 lakh rupees. Why 3 lakhs has come? 4 lakhs minus 1 lakh will become 3 lakhs. So 1000 plus 0.5% of 3 lakhs. 0.5% of 3 lakhs will come to 1500. 1500 plus 1000 will work out to 2500. So if the currency exchange is 4 lakh rupees, then the value of supply will be 2500. So friends, let me repeat the concept once again. Rule 32.2b is an optional mechanism, but if it is once opted, it cannot be withdrawn during remaining part of the financial year. An important point to be noted there is that in Rule 32.2b, valuation is based on the amount of currency exchanged. So up to 1 lakh, 1% of currency exchange, minimum 250 rupees. 1 lakh to 10 lakhs, 1000 plus 0.5% of currency in excess of 1 lakh. Finally, last one, above 10 lakhs, then the answer is 5500 plus. Why did 5500 come? Apply logic, come on. Up to 1 lakh it was 1%. On 1 lakh 1% is how much? 1000. What is the next figure? 1 lakh to 10 lakhs. 1 lakh to 10 lakhs, what is the gap? 9 lakhs. On 9 lakhs, 0.5% comes to 4500. That 4500 plus 1000 became 5500. So if the amount of currency exchange is more than 10 lakhs, then the value of supply will be 5500 plus 0.1% of currency in excess of 10 lakhs. So for example, let's say currency exchange is 15 lakh rupees. Then the value of supply will be 5500 plus 0.1% of 5 lakh rupees. That becomes the value of supply. So friends, what is the answer in 32.2b? Up to 1 lakh, 1% of currency exchange, minimum 250 rupees. 1 lakh to 10 lakhs, 1000 plus 0.5% of currency in excess of 1 lakh. Up to 10 lakhs. Above 10 lakhs, 5,500 plus 0.1% of amount exceeding 10 lakhs, but maximum 60,000. So friends, in the first line they have given minimum 250 rupees and the last line they have given maximum 60,000. And the 60,000, please don't think that the 60,000 is per year or 60,000 is per month. The 60,000 and all is per transaction of currency exchanged. So friends, what is the answer now? Rule 32(2)(b) is an optional method of valuation which once opted cannot be withdrawn during remaining part of the financial year. Up to 1 lakh, 1% of currency exchange, minimum 250 rupees. 1 lakh to 10 lakhs, 1000 plus 0.5% of currency in excess of 1 lakh up to 10 lakhs. Then finally, above 10 lakhs, 5,500 plus 0.1% of amount exceeding 10 lakhs, but maximum 60,000. So friends, to summarize the whole concept of Rule 32(2), what is the answer now? In Rule 32(2), we have got two bifurcations, 32(2)(a), 32(2)(b). 32(2)(a) talks about in case where RBI rate is available, then the difference will become value of supply. And if RBI rate is not available, then value of supply will be 1% of currency exchange. And if we convert one foreign currency into another foreign currency, then 1% of lesser of two amounts in Indian rupees will become the value of supply. Other side, Rule 32(2)(b) is an optional rule which we can't withdraw in middle of the financial year. And there, the valuation is based on the amount of currency exchanged. Up to 1 lakh, 1% of currency exchange, minimum 250 rupees. 1 lakh to 10 lakhs, 1000 plus 0.5% of 10 lakhs minus 1 lakh. I mean to say 0.5% of currency in excess of 1 lakh. Clear, right? Exactly. Finally, last one, above 10 lakhs, 5,500 plus 0.1% of amount exceeding 10 lakhs, maximum 60,000. Done. So friends, now let's look at couple of interesting questions with respect to Rule 32(2) so that we get good clarity of thought on what we discussed so far. Come on, look at this question. Mr. X, a money changer, has exchanged 10,000 US dollars to Indian rupees at 64 per dollar. Then, Mr. X wants to value the supply in accordance with Rule 32(2)(b) of the CGST rules. Determine the value of supply made by Mr. X. You have to observe very clearly in the question that they have specified that X is a money changer and he exchanged $10,000 into Indian rupees at 64 per dollar. And they themselves has clearly given in the question that valuation is required as per Rule 32(2)(b). They will specify, don't worry. So when we are talking about Rule 32(2)(b), RBI rate will become irrelevant. Now what is Rule 32(2)(b)? Rule 32(2)(b) valuation is based on the amount of currency exchanged. Now here what is the currency exchange? $10,000 at 64 per dollar. $10,000 at 64 per dollar will become 6,40,000. Now 6,40,000, if we have to apply the valuation under 32(2)(b), it falls in second slab. So what is the answer then? 1,000 plus 0.5% of 6,40,000 minus 1 lakh. That is 1,000 plus 0.5% of 5,40,000. And 0.5% of 5,40,000 will become 2,700. 1,000 plus 2,700 will become 3,700. So with this, the value of supply will become 3,700. That's it. Pretty simple and easy, provided you know. That's very important that you should know. Only then we have that sense of thought process that it's very easy and simple. Come on, my dear students. Now let's look at another interesting question. See now. Prada Forex Private Limited, registered in Delhi, is a money changer. It has undertaken the following purchase and sale of foreign currency. First bit. In this question, they have given two bits. Let's see them independently. First bit. 1,000 US dollars are purchased from Nandi Enterprises at the rate of 68 per dollar. RBI reference rate for US dollar on that date is 68.60. This is the first bit what they have given. Second bit. 2,000 US dollars are sold to Meenavati at the rate of 67.50 per dollar. RBI reference rate for US dollar for that day is not available. Good. So first bit they have given the RBI rate and they told it is available and they have given that as 68.60. Second case where $2,000 are given to Meenavati at 67.50. On that date, RBI rate is not available. Possible. See below. Determine the value of supply in each of the above case in terms of Rule 32.2a, and second bit they also asked Rule 32.2b. What a brilliant question. They are asking about value of supply with respect to Rule 32.2a also, Rule 32.2b also. Let's do that. Come on friends, let's solve the problem and close this so that we get complete clarity of thought on Rule 32.2a as well as Rule 32.2b. Come on. So one side, let's talk about Rule 32.2a. Other side, let's talk about Rule 32.2b also. In exam, you can present one after other, but for the sake of convenience, I am writing it adjacent to each other. But in exam, please do write one after other. And Rule 32.2a, what is the concept by the way? In exam, just don't throw the answer. Please write the concept also. What is the concept? Value of supply will be if RBI rate is available on that date, then the difference between RBI rate and the exchange rate given by money changer multiplied by total units of currency will become the value of supply. And if RBI rate is not available, the value of supply will be 1% of currency exchanged. See that now. First case, we know that RBI rate is available. And what was the RBI rate? RBI rate was 68.60 and the exchange rate given by the money changer was 68 and the units of currency was 1000 units. So friends, what is the answer then? 1000 units into 68.60 minus 68, which becomes how much, my dear friends? 0.60 into $1,000. 0.60 into $1,000 will become how much, my dear friends? 600. This becomes the value of supply. Pretty simple. But other side, same scenario, if I look at Rule 32.2b, then the concept is altogether different. Now what is that different? Value of supply will be, first of all, what is the exchange rate? Exchange rate is nothing but 68. And the dollars involved are how much, my dear friends? $1,000. The gross amount of currency what has been exchanged is nothing but $1,000 into 68. Correct friends? How much it becomes? $1,000 into 68 will become how much? Come on. $1,000 into 68 will become 68,000. And my value of supply will turn out to be 1% of 68,000, which comes to 680. So if you observe very clearly, my valuation answer is different when I apply 32.2a and it's different when I applied 32.2b. But we all know one point to be kept in mind, that is Rule 32.2b is optional, and if it is once opted, it cannot be withdrawn during remaining part of the financial year. Next, let's look at the second bit also. Second bit is a case where they have clearly given in the question $2,000 is exchanged at a price of 67.50 per dollar and RBI reference rate on that day is not available. So we know that if RBI reference rate is not available, then my value of supply turns out to be 1% of currency exchanged into Indian rupees. 1% of currency exchanged in Indian rupees. So 1% of $2,000 into 67.50. So if I just calculate, my dear friends, let me do that working. So if you see that very clearly, $2,000 into 67.50 works out to 1,35,000, and 1,35,000 into 1% comes to 1,350. That becomes my value of supply. So if you observe very clearly here, we have applied the concept of 1% of currency exchange simply because RBI rate is not available. If RBI rate would have been available, then the difference would have become value of supply. Come on. So let's do the calculation for 32.2b also and close this particular question. So if I have to look at 32.2b, then what is the answer? Straight away, 32.2b, if I look at very clearly, exchange rate is 67.50 50 and dollars is $2,000. So technically my currency exchange is nothing but 1,35,000, and when it is 1,35,000, we know that my value of supply will be 1,000 plus 0.5% of 35,000. And why we are taking 0.5% of 35,000 is very clear. Up to 1 lakh, it is 1% of currency exchange, minimum 250 rupees. 1 lakh to 10 lakhs, 1,000 plus 0.5% of currency exceeding 1 lakh. Above 10 lakhs, 5,500 plus 0.1% of amount exceeding 10 lakhs, maximum 60,000. So 1,000 plus 0.5% of 35,000. So this becomes 1,000 plus 175, which comes to 1175. So my value of supply will turn out to be 1175. You can observe very clearly in the answer what we have presented, that when we apply rule 32 to A, the answer is different. When we apply rule 32 to B, the answer is different. Both of them are two different valuation mechanism. But it is utmost important to be kept in mind. Again, I am repeating this point, that rule 32 to B is optional, but once opted, it cannot be withdrawn during remaining part of the financial year. So that's the end of story of this beautiful problem.